Hello and welcome to SPY Trader Now video for the week ending December 3rd, 2022. My name is Ken and I am your host. SPY Trader Now is my YouTube handle and spytradernow.com is my website. This is where I show you my portfolio, which is here on the first page, and trades, which I just have a snippet of my trades right here on this page. And you will see firsthand whether my trading style can produce favorable results or not. And all you have to do is subscribe to my channel and ring that bell to be notified when I post a new video to YouTube. Here is the profit and loss column. You can see my percentage gains, and here is my profit and loss in dollars, and see how much money I've gained. The portfolio starts with $100,000 at the beginning of each year, so I can do year-to-date results. My trading style can be used as a standalone for a complete portfolio, or can be used for a portion of a portfolio that can be invested at risk. Not only will I show you my trades, but I compare my results against the S&P 500. Here you can see the S&P 500 with the buy and hold strategy. Year-to-date returns, the S&P is down about 14%, and I'm up a little bit better than 20%. My portfolio is currently invested all in cash. I have a 3-position portfolio. That's it, 3 positions. You either own shares of SPY, which is the S&P 500 ETF, symbol SPY, and I just refer to it as SPY, and I also refer to it as stock synonymously. Or I have SPY options, or I'm in cash. Currently I'm in cash. Cash is a position, folks, and you want to use it when it is prudent to do so. I believe all traders should be comparing their results against a S&P 500 buy and hold strategy. Otherwise, how else are you going to determine how well your returns are doing? A lot of traders just say, oh, well, I did this much, I returned 2.65% on this trade, or I returned 16% on this trade. But they don't tell you how well that they do over a portfolio, because they don't tell you exactly how much of the portfolio to invest. I give you that information right here. This is the trade and how much of your portfolio should be invested in this position. This is an example of, this is how I present how I trade. So I'm giving you all the information all right there. If you want to receive my real-time trade alerts, sign up for them at spytradernow.com. And also you can see a full list of all my trades going back 3 years. As I mentioned earlier, I do reset my portfolio back to $100,000, which you can see right here, starting capital, $100,000. This is the starting price of SPY at the beginning of the year. And that way you can see how we do when we do our year-to-date returns. I want to keep my videos as short as possible. The videos will consist of my past week's trades and my technical analysis of why I made those trades and how I am positioned now for the upcoming week. As you know, I'm currently in cash. I'm going to wait this out right now. The market action will determine how many trades I place and how often I place those trades. You can see my trade dates here when I opened the trade, and over here the sell dates of when I closed the trades. The week on Wednesday, 11/30/22, I added to the portfolio with a 10% allocation. You can see right here where I highlighted it. All the highlighted trades are the action that took place this week. On the 30th, I added a 10% position with a long call option with a 445 strike with an expiration date of 12/15/23. But I got out of the trade just on Friday because I didn't feel like I wanted to have that leveraged position. Let me explain what I mean by leveraged. Okay, so it's a 3-position portfolio. When you own SPY shares, just the stock shares themselves, that's non-leveraged. You just simply own shares of SPY. Here, when you have options, that's a leveraged position because options are going to spike up and spike down much more quicker than the price of the SPY shares. So this is non-leveraged, this is leveraged, and this is cash. Cash, you're safe and you're on the sidelines. Your portfolio isn't going up, it isn't going down, it's just staying steady, which is where we're at right now. We are just staying steady. on Friday, end of trading day, I exited all my positions, which you can see here, 12-2-22, 3 exits. I closed those positions. We were profitable in these 2 SPY shares. We were not profitable in this option. I took an $80 hit, very, very small, minuscule hit, and I was nicely profitable in the share. So we just took the money off the table, put ourselves on the sideline to watch the market action. And now I'm going to go over why I made the choice to exit into a cash portfolio. And let's go through that right now. I know this is not accurate, but what I'm starting to do, and I just started this a couple weeks ago, is tracking the portfolio so we can see how well the portfolio goes up and goes down throughout the year. So I know that I didn't flatline at $100,000 and then all of a sudden jump up. So I know this is not accurate data. It is as of this date, but this is not accurate because the portfolio moved around. But moving forward, this will be good. This graph will look the best starting in 2023, because in 2023, we're going to be starting off from a fresh slate at $100,000 when we reset the portfolio. But I just wanted to explain, I'm going to be introducing this into my weekly video so we can see how well we are doing on a cash basis. Here is what the S&P 500 did. This is accurate from the beginning of the year on January 1st, 2022 to today. So you can see how it kind of moves around. We're going to compare ourselves against the S&P 500. This is with the buy and hold strategy. Now here we are. I know this is not accurate, but this is now on a percentage basis between the 2 portfolios. SPY, buy and hold in the pink, and in the blue, the SPY Trader Now portfolio on a percentage year to date. Both of these are year to date portfolios. So this is not accurate, I realize that, but moving forward, we will be able to compare our accuracy against what the S&P 500 does 100%. Now I want to explain, why did I exit the stock market and go into cash? One of the reasons why, I've got about 5 reasons, but one of the reasons why is the jobs report. Now, the jobs report came out with 263,000 new jobs in November when the forecast was 200,000. That's hotter than expected. The unemployment rate remained steady at 3.7%. The Fed, I should say, wants the unemployment rate to not stay steady. He wants the unemployment rate to go up, because with the unemployment rate going up, that's a softening economy, meaning that inflation is going to come down. That is the goal of the Fed. The Fed actually has 2 mandates. The first mandate is inflation, and the second mandate is the unemployment rate. They can let the unemployment rate get more worse than 3.7% and still have a strong economy, but it's the inflation that's out of control. This is the head of the Fed. His name is Jerome Powell, and he's the current Fed chair. So he's the top person that is making the decisions on how interest rates, what he does with interest rates. That's the tool that the Fed has that he can adjust to determine what happens with the economy. When the Fed has a rising interest rates, which is what he's doing to tame this high inflation number, 2022 inflation rate, okay? We peaked at just over 9% and we're coming down just below 8%. This graph makes inflation look okay. But when you go back over the longer term, this is going back to 2018, you can see that we're hovering closer to 2%. 2% is the Fed's target. This is what the Fed chair wants. He doesn't want this just under 8% inflation rate. He wants 2%. The tool that he has to use to combat this inflation is rising interest rates. He's going to push those interest rates up to get this inflation number down to 2. So some of that has already happened, and I know he doesn't want to overshoot, but he's still, the path that he's on still needs to bring this down. So he's still in a rising interest rate environment for us. As stock market investors, that makes it a little less favorable for us, because the people who are thinking about investing, This rising interest rate is going to make bonds look more attractive because you're going to get safer returns with a higher interest rate on your bond returns. Bonds are safer. So the money is going to come out of the stock market. It's going to go into bonds. Basically, prices are we're going to lose money if we're invested during that time frame. So that's something we want to watch out for. This is one of the main reasons why I wanted to exit on Friday to cash. Also, the VIX. So the VIX is the volatility index. So the VIX spikes up when the market is coming down because people are buying insurance. It's like it's a mechanism to kind of see what is happening in the stock market. The best time to be invested in the stock market is when the VIX is high and traveling down low like this. This is when the S&P 500 gets its best gains. This is why I've got the notes in here. You're going to buy the S&P 500 here and you want to sell the S&P 500 here. That is not always true if you're going to remain in this low range. If you're going to remain in this low range and not come out and go into these high levels, that can also be a favorable time to be invested. But when you come out of this low range, 20 as an example, and you start creeping up, this is when you want to get out. And when it happens very, very fast, within a couple of days. And that's when the market is absolutely tanking. So right now we're at a low level. And if you look at the cycle timing on where we are here to here to here, we could move sideways for a little while and like this, and then comes back up. But I'm leery. I don't want to be in a position or even in a leveraged position when the market goes from here to here, because this is the time you're going to lose money in the S&P 500. Another thing that I'm concerned about, looking at a daily chart going back 5 years, and you look at the MACD. I actually did this over 20 years, but the MACD is currently at 6.586. which is a pretty high number. Go back 20 years, we've only reached this number or higher where these lines are at, which is basically since 2020. So it's only 7 times that it's reached 6.586 or higher on the MACD. And every time it's done that, not every time, most of the times it's done that, we've had a market correction of at least 6%, some of them even worse. If you look over here since 2022, the last 2 times that it did this, it was a very big drop here and a very big drop here. Here we are right now today, and we are at 6.8. The MACD, all things resort back to the medium. So, the medium is the 0 line, so all things will eventually come back to 0 at some point in time because this is an oscillator. We are at a very high level. It's due to come down. The best way for it to come down, there's 2 ways for it to come down, with sideways moving action and with downward moving action. There's a reasonable probability that we're going to have downward moving action from this level. So that's another reason why I wanted to exit into cash. Go through the next reason. This is on a daily chart of the S&P 500, and I drew a downtrending resistance line from the tops of the previous peaks here in 2022. And if you see this line here and where it carries to, it takes us to where we are at right now. We actually kissed it and came down slightly, but we found support at the 200-day moving average. On Friday's action, when that jobs report and unemployment rate came out, the market, when it first came out, the market tanked, but it found support at the 200-day, and if that's a bullish candle, because it came down, found support, and closed up. So I have mixed feelings about this market, and I probably should have some non-leveraged money in the market, maybe 25 to even 50% of non-leveraged S&P 500 shares could be in the market at this time, because there is a possibility that it could go up. But let's let it break this resistance line. There's actually 2 resistance lines. This downtrending resistance line and also the previous peak here. Those actually line up. It needs to break both of those, get above that, and then we will have broken those 2 things. One of the reasons why I did like the S&P 500 when it came out on Wednesday, when it broke out on Wednesday. This was an extremely bullish candle on big volume, which is really strong. But I was looking for more follow through, which we did not get. But this was a very strong move. And the MACD came down and bounced above the red signal line. That is a bullish sign. The only thing that I don't know is I think this market's got more room to grow. The only thing is how much room does it have to grow? Wait till I go through the next slides and you'll see that I think that this rally is going to run out of steam in not too distant future. That's my expectation, but let's see. This is the same chart, the S&P 500, but on a different platform. This is my broker of choice, the broker that SPY Trader now recommends, which is TD Ameritrade. This is the Think or Swim platform, which is a fantastic platform that they offer. And the chart that you're looking at now, the gold lines here, this is a one-year chart. The gold lines represent a -2 and a +2 standard deviation. The pink lines represent a -1 and a +1 standard deviation. The market generally, 65% of the time, I believe that number is accurate, will trade in between the -1 and the +1 standard deviation, and 95% of the time will travel between the -2 and +2 standard deviation line. Over the past year, you see how much time we have spent between +1 and +2? We have only spent 3 days in the range of +1 to +2 standard deviation. Oh, wait a minute, there's a little bit right there. A couple more days, 5 days in total over the past 12 months. That's not a lot of time to spend in the +1 to +2 standard deviation line. Eventually, this market will turn around and we will come up. But if it happens now, that will be the first time in 12 months. And I'm not sure if I want to be holding a long position during the time that it does it for the first time. I'd rather be a little more conservative and let's just let it come up and let it come down. And then when it comes back up again and it's proven that it can spend some time in this range, then we can come back and be long during that time frame. But right now, look what happened the last 2 times it came up to the +1 standard deviation. Came down, came down. So I'm expecting some resistance to happen during this time frame. So that's why another reason why I wanted to go to cash. I've got my alerts in here to let me know, just in case the market starts jumping around and starts doing stuff. Think or Swim platform to let me know, hey, this is what's going on if the market comes down or goes up. So I'll be they set you up with alerts if you wanted. One of the reasons that makes the market bullish is that we made a Fibonacci measured move here. So as the market comes up, it makes a high, it makes a low, it makes a high, it makes a low, but that's a higher low. Then we made a high, that's a higher high than this high. Then we made a low, that's a higher low than this low and this low. Then we came up and we broke this high on this candle on Wednesday. That is a measured move because we broke that line. When we broke that line, that is when I bought in an additional return. I can't even remember which one it was. Let's go back and see what trade that was. I did 10%. I put 10% in long call options on the 30th. I took the money off the table with the small $80 loss, but on the 30th, that was the trade that I made. All right, let's go back down to where we were. And looking at this measured move, that's when I made that trade right there. The market came up, kissed all those resistance lines, came back down, and I just want to see it break out if I'm going to continue on with this. On the Fibonacci extension, when I put that in, it has it automatically puts in on the Think or Swim platform the 127 and the 161 Fibonacci extension. These are targets. So there's a good probability with this measured move that if we can continue on in an upward advance, that we should reach the 127 Fibonacci extension. On the 3-month chart, you'll see that's above the +2 standard deviation. But when you go to the 1-year chart, you'll see that the 127 is just below the +2 standard deviation. So it is definitely a possible target. And December is seasonally a good, strong, bullish month. I want to see the market clear all this before I even want to put in some money. And if I do put some more money back in, I'm going to put it in non-leveraged, not leveraged, because we are already between the +1 and the +2 standard deviation. There's not much room before this market will turn around and come back down and correct. That is going to conclude this video. Please hit the subscribe button, ring that bell to be notified when I post a new video, and good luck on your trading.